Good morning. All the central banks in the world are accumulators of gold, and none of them are sellers. We shared recently how the BRICS countries are building a global trade and financial system that is gold denominated while using their national currencies for bilateral trading. Large volumes of gold are being bought on European exchanges and moved to Switzerland and to vaults here in Asia to collateralize their new system. Gold Fix is a Substack publication, and they explain in this report that there is another strategy involved as well. Central banks are striking deals with gold producers, gold mines. They're buying that gold directly so that the gold never goes to Europe in the first place. You guys should be ashamed of yourselves for how much you charge on subscriptions, just by the way. It is a strong report, though. The LBMA is the London Bullion Market Association. As central banks buy gold directly from suppliers, Western banks' access to the physical goes away, and the BRICS countries are keeping it all for themselves. What the BRICS are doing in gold, they're doing in everything. This is the strategy that China has executed time and time again to lock up all the supply chains in the world for everything important. Food, energy, raw materials, metals, now here in gold. Chinese companies will go directly to the source, wherever it is in the world. They negotiate directly with local suppliers and pay a premium price to win the contract. The local producer makes more money selling to China, and Chinese companies pay less money because they get access to those materials at a still much lower price than were they to go through intermediaries in Western countries and process payments through Western banks and buy and settle contracts on Western commodities exchanges. We're watching it now across the entire ag sector. Chinese companies are dealing directly with grain producers in South America and Russia, and we don't see any of this activity on our own exchanges anymore. Chinese firms have done the same in Africa, in the chocolate markets. African cocoa producers in Ivory Coast and Ghana are making more money selling directly to China. And Chinese companies are paying less for the chocolate because there are no intermediaries in London skimming off of both sides. This led to shortages of chocolate in Western markets, big spikes in price, while the BRICS markets were well supplied and they didn't notice. That's a preview of what's coming soon for physical gold markets. Gold is coming directly out of the ground, and instead of being registered for futures trading on Western commodities exchanges, it's going directly to central bank buyers. There is a hiccup here. LGD is London Good Delivery, and it's a protocol for inspection and testing to make sure the gold, in this case, is real, and it truly represents what the buyers and sellers of the gold contract think they're dealing with. But central bank buyers of the physical will be even more motivated than anyone in London to make sure they're really getting what they're paying for. So the good delivery problem goes away, along with the need to use London or New York for anything. So the central banks are building up their gold reserves and going directly to the local producers. That helps local mines and miners, and it doesn't hit their FX reserves. They can pay in local currencies for the gold produced in their own domestic markets. South American and African central banks are realizing that this is the easiest way to build out their reserves. Ghana and Tanzania are examples. Their template here is an agreement to buy 20% of the production of their local mines. So that's the first big piece then. Central banks from around the world sourcing their gold from local miners and local currencies. The other part of the story is that Chinese mining companies are buying up mines across the world and locking up gold production and supply that can be sent directly to BRICS vaults. Last month, Xi bought one of the biggest mines in Kazakhstan for $1.2 billion. Another Chinese company is soon to take over the mines from a Canadian company, Lumina Group. This deal is for $581 million, and it needs to be approved by the Canadian government. Canada has stopped deals in critical minerals, like in lithium and copper, but gold is not considered a critical mineral. So copper is, but gold is not, so make of that what you will. But analysts strongly believe that the sale will go through. Last year, another Canadian gold exploration company, Osino Resources, was sold to Yantai Gold, and that involved large properties in Namibia. This part's important. Yintai's bid was superior to the one that the company had previously accepted from Dundee Precious Metals. Dundee is a Canadian company who was trying to buy another Canadian company for gold mining claims in Namibia. Yantai offered a 32% premium over Dundee and included a new operating loan to get the mine going and paid the termination fee. And that deal was approved quickly by the government regulators in Canada and China. Qifeng Gold is another major operator in China looking to acquire properties across the world. They've got 5 mines here in China and scooped up others in Laos and Ghana. And now Qifeng produces over 15 tons of gold per year. China is the world's largest producer of gold already, and their miners are looking to grow even further by buying productive mines across the world. Hong Kong is key again to making that work. Chinese gold miners make money every time they pull dirt out of the ground, but even they use Hong Kong banks to raise capital and do business with the world outside mainland China. Here is yet another acquisition, yet again in Ghana, and again going through Hong Kong. Zijin paid $1 billion in cash to Newmont, a US company, for an open pit mine in Ghana. Zijin is also going through Hong Kong. Production is estimated to be 5.8 tons per year for 15 years after it opens in 2028. It's a weird coincidence that Ghana is a major producer of cocoa, number 2 in the world, and a major producer of gold, where they're number 8. And we're watching the same thing happen in both the cocoa and bullion markets, and for the same reasons. Chinese companies are buying production directly from suppliers, cutting out Western banks and brokers. Gold is being drained from our vaults and sent to BRICS countries, and central banks and Chinese mining companies and Hong Kong investment banks are making sure there isn't any new gold coming our way. This is Century Park in Shanghai. Be good.
Thy kingdom come, thy will be done on earth as it is in heaven. Give us this day our daily bread, and forgive us our debts, as we forgive our debtors. Lead us not into temptation, but deliver us from evil.